Hey, good morning, Max. How you doing? Uh, how's the mic sounding? Is it okay for you? Too soft, too loud? Any adjustments need to make? Lupus, how you doing? I think first time I've seen you here. Welcome aboard, Lupus. Cyber, how you doing? First time I've seen you as well, I believe. Thanks for coming. Welcome aboard. Pretty interesting week we had last week. Gotta say, old Jay Powell stirring up the markets again. Yeah, first time Lupus. I usually I try and remember who I see. Sean McDonald, how you doing? Did you watch Formula One? No, I didn't. I went to the first F1 and I think I'm still deaf from the first one, so I've never gone back. But the first one was actually pretty good. I had an opportunity to do photography there, so that was pretty nice. Ron, how you doing, Ron? Peter Brown, how you doing? I think first time I've seen both of you as well. Welcome aboard. Thanks for being here. Okay, Sergio, same. First time. I think I've seen your name as well. Welcome aboard. Okay, and so with that, I guess we'll go ahead and start the live stream. How's everyone doing? Glad you could be here with us today, wherever you might be. And if you're in Europe, I know it's pretty late. Thanks for being here. If you're in the state, I know it's pretty late as well, or getting there. Thanks for being here. If you're in Asia, good morning. It is Monday morning here, 9 a.m. in Singapore, and it's good to see all you folks here. Take a quick look at the comments. Peter Brown manipulation. You never know. You just never know, but it does seem that it does happen quite a bit, as we saw again with JP Morgan. Yeah, Ron, first time viewer. Thanks for coming aboard. So again, it is Monday morning here in Singapore, and first thing we want to do is go ahead and take a look at gold and silver prices and see where they're heading. I haven't taken a look at them yet, so this is my first peek as well. Um, so heading on over to our website to take a quick look in US dollars. Silver back at that $18 range, so that's pretty good. Gold still about 1500, so that's pretty good as well, considering all the news that's been going on. But again, if you are new to this channel or first time here or you haven't already done so, please do go ahead and subscribe to our channel. Click on that bell to be notified on updates and give us a thumbs up if you like what we do. We appreciate your support. Those thumbs up, they do help out more than you know, so we appreciate that also if we could get those thumbs up. And you can also find us on social media, as I just showed you there, our website, silverbullion.com.sg. We are a bullion dealer, buy and sell precious metals. We store precious metals over in Singapore, and you can even take out loans against what you have stored, using them as collateral in what we call P2P loans. Excuse me. And that is a pretty popular feature that a lot of people do take advantage of. You can find us on Facebook, Silver Bullion SG, Twitter, Silver Bullion, or at Silver Bullion PL for private limited. If you just want the audio versions, you can find us at SBTV iTunes and SBTV Spotify. And we do have a crisis tracker group on Telegram, which I will put the link up later on. Like, yeah, I'll get the link for that later and put it up put it up on there for you as well. Sorry about that. So again, welcome aboard, everyone. Glad you're here. Full name. That's a good one. Full name. How you doing? Continuous manipulation. Yeah, it just seems to keep going on and on and on. Continuous manipulation, just like you said. Troy Rivers, North Pole, Alaska. Okay. Del Santa Claus, we said hello, but first time I think I've seen you here as well. Welcome aboard. Jorge Barajas, welcome aboard. Appreciate you guys being here and helping to support our channel. So once again, taking a look at those prices, we did see a little bit of movement. But just a heads up again, we do now take Australian dollars, Hong Kong dollars, British pound, and Canadian dollars, and that was due to your request. So, thank you for letting us know what can help you all best suit your situations. We are having 75% off on the transfer in fees, meaning if you have gold and silver and you want to bring it on over into our vault, we are discounting those fees by 75%. So again, silver back above 18, which is a good thing considering everything that's been going on, the pressure that's been applied to silver, that's been applied to gold. They've been hanging on, and I think it just goes to say that there is a lot of fear and uncertainty in the market still, and guys are coming over to gold and silver. And if we take a look at that ratio, it's at 84.1 right now, meaning it takes 84 ounces of silver to equal 1 ounce of gold price wise. And typically, whenever that ratio is above 80, you want to be buying silver. And I know for me, I'm definitely getting silver. Looking at that ratio. So going into some of the news, a lot of it had to do with the Fed lowering the interest rate, the Fed funds rate. A lot of it has to do with what's going on in the repo markets, and we're going to take a look at that. And we're also going to take a look back at what happened with AIG on the timeline that I had showed you guys last week. So we'll get into that. But first thing I want to get into is something pretty interesting that Peter Schiff said. So I'll go ahead and play that clip for you.
Sure. I mean, I understand that you don't think that the primary reason for, gold and silver going down is this market manipulation, right? I understand you're of the position that people just don't understand gold and silver. They don't understand how the Fed works. And that's why these prices are going down. Is that correct?
Yeah, and first of all, the price of gold went from under $300 an ounce in 2001 to almost $2,000 an ounce in 2011. So if people were trying to suppress the price of gold, they were doing a pretty bad job because the price went way up. Now, we did have a correction. We went down to almost 1,000, but now we've gone up about 50% since then. But yeah, I think the price should be a lot higher, but it's not where it is because of manipulation. It's a lack of understanding on the part of investors around the world of the real situation that's going on economically. It's too much trust in central banks and fiat money, but when that trust ultimately gives way, and it will, you're going to see a rush to buy precious metals. It's already happening now. The central banks are buying gold. It's not going to be long before the investor class follows their lead.
Now, are we on our way to seeing the destruction of the U.S. dollar?
Well, we've been on our way to the destruction of the dollar for a long time. In fact, it's taking a lot longer than a lot of people might have thought, myself included. So we've been able to keep this thing going. It's a much bigger bubble. But yes, I mean, if you can read the writing on the wall, it's quite clear what's going on. Most people are in denial, but those who aren't are preparing. And even if you prepare too early, that's fine, because it's much better than preparing too late, which means you're not prepared at all.
Okay, so are you preparing? I think most of you are. Most of you already know what silver and gold represent. It's not just an investment; it's an insurance. It's a store of wealth or a store of value as well. And I think most of us already know that. A few of us were just starting to understand the concept. But what Peter said was pretty interesting in that he doesn't see the manipulation as being a bigger factor as most of us think it to be. So that was pretty interesting. And taking a look at some of your comments, Peter has lost followers. He loses some, he gains some. But I think for the most part, Peter is still one of those. He is a beacon. He's, whether you like him or not, he can be a bit polarizing as well. But for the most part, it's because he knows silver and gold, and he sees silver and gold in a lot of different ways than most of us may see it. Okay, so Steve Stackpole, first time I've seen you here also. Welcome aboard. Exciting times. Yes, definitely exciting times. Jessel, first time I've seen you here as well. Welcome aboard. Okay, Frank, thank you, Frank. Appreciate that. Let me get back to one question. Wantian, what happened to all of the USD liquidity in the P2P market? Well, it's doing exactly what it's meant to do. We've had people who do store with us, and they've been seeing what's going on, and they've been taking out peer-to-peer loans using their silver and gold as collateral, and we've been having a lot of or quite a few um, big clients who have decided to collateralize what they've had, and but lenders are they're there. Lenders are always there, so I'm sure probably even by today or with definitely within the week you're going to see a lot of lenders again. But it's just that, like I said, there is a lot of uncertainty in the markets, and so people are wanting to load up on cash, which is a good thing because banks want to load up on cash as well, right? Which is why we saw what happened in the repo market last week. But Peter Schiff, he did talk about de-dollarization, and there's a lot of talk about going cashless as well. So I'm curious. I'd really like to know your opinions on the pros and cons of moving to a cashless society. So this, came out a couple of months ago, and so this guy he listed the benefits and disadvantages, or the pros and cons of going cashless. And so I'm always wondering what people's take on going cashless is. So he goes on to say that the benefits of going cashless: lower crime, less money laundering, less time and costs associated with handling paper money. I guess that's for more for businesses. Easier currency exchange while traveling internationally. Okay, so there's a few points, and when we look at the disadvantages, exposes personal information. If hackers drain your bank account, okay, that's one thing. Technology issues, sure, that's another thing. The poor and those without bank accounts will have difficulty paying and receiving payments. That's true because this is under the assumption that everyone has a bank account, and from what I see with a lot of you guys out there as well, not everyone chooses to have a bank account, or just the very minimum stays in that bank account. So that's also an issue. Some might find it harder to control spending when they don't see physical cash leaving their hands. That's true. It might be easier to go ahead and spend, and banks may start charging fees to compensate for possible negative interest rates. That's another thing. Once you go cashless, you really your money is in someone else's control, basically, where they can move interest rates and things like that to get you to spend, get you to slow down. So it's a way for them to control the economy a bit better as well. Okay, some of your comments. Let's see. Sorry about that. Cashless only really benefits the controlling faction. I mean, it does have some benefits, as this author just mentioned in his article, but there are also some disadvantages. So I think it really just depends how you look at it, which is why I'm always interested to see opinions on going cashless, because we just had Peter Schiff saying de-dollarization, and now we see another article going cashless. So it's good to have some opinions on there. Redrum Twins, first time I've seen you here as well. Welcome aboard. Cashless means banks, IRS, and government can steal your money at any time. You won't be able to save it or hide it, give it to others. Banks want to impose negative rates and steal it. That's a common thing that people often say. They do have a concern, you know, with cashless, because a lot of them feel like when you go cashless, you have less privacy, and I know privacy is important to a lot of people, as it should be. So that is another issue as well. And RGJGJ, one more time. Patrick, is your P2P lending dead? No, not at all. It's acting just as it should. There were quite a big people who wanted to collateralize against what they store, which is a good thing. I mean, because a lot of times you put gold and silver in a vault, or you store it. Even if you store it at home, it sits in a safe, and it just sits there. And with our P2P, when it's in the vault, what happens is you can use your gold and silver as collateral and redeploy, reinvest, whatever you want to do. So instead of having your silver and gold just sit there, it actually can go back to work for you, and you can collateralize it and redeploy your assets. And that's what we've had. We've had people, redeploying assets. And not to worry, there, like I say, there are lenders and there are always going to be lenders. So that's, you're going to see lenders probably start to pop up really soon, because they're going to go ahead and take a look at it just like you, and they're going to say, hey, perfect time to go ahead and lend money. So if probably that might be you. So if you have money that maybe you want to work for you, let us know. Contact us, sales at silverbullion.com.sg, and we can walk you through the peer-to-peer program. And it's like I say, it's a good thing. It's working exactly how it needs to work, and guys understand, hey, I can put my gold to silver for work for me, and that's all they did. So again, it's working exactly how it should. I think it's a pretty cool thing to see, actually, because normally we have more lenders than borrowers. This time around, we got more guys that want to redeploy assets. So it's a good thing. Not to worry. Not to worry. One more bit of news that came out I want to talk about fairly recently was from our good friends at the IMF. So we like those guys, right? They're good friends here. So they had this article recently. It came out September 19th, where digital currencies, the rise of stable coins. So we had Peter Schiff talking about de-dollarization. We have people talking about going cashless. We have the IMF talking about stable coins. So, looking at the article, a battle is raging for your wallet. New entrants want to occupy the space once used by paper bills or your debit card. The adoption of new digital payment methods could bring significant benefits to customers and society: improved efficiency, greater competition, broader financial inclusion, and more innovation. But it could invite risks to financial stability and integrity, monetary policy effectiveness, and competition standards, as outlined in a recent IMF staff paper. And this is the first in a new series. And basically, one thing it points out is that adoption of new forms of money will depend on their attractiveness as a store of value and means of payment. Most of us already see gold and silver as that store of value. And then the question becomes, how do we use that gold and silver as a means of payment? So I think this is one thing that they want to try and talk about through stablecoin adoption. Adoption of new forms of money will depend on their attractiveness, okay, which is what we just read. However, new entrants like stablecoins, however, are significantly different from the popular incumbents, cash or bank deposits. While many stablecoins continue to be claims on the issuing institution or its underlying assets, and many offer redemption guarantees at face value, meaning a coin bought for 10 euros can be exchanged back for a 10 euro note like a bank account. Government backing is absent. Okay, government backing is absent. Trust must be generated privately by backing coin issuance with safe and liquid assets, and the settlement technology is usually decentralized based on the blockchain model. He goes on to say times are changing. Recently launched in times are changing. USD coin. Sorry about that. USD coin recently launched in 85 countries. Facebook announced Libra. I think most of us have heard of Libra before. And centralized variants of the stablecoin business model are becoming widespread. So why are stablecoins taking off? Good question. The strength of stablecoins is their attractiveness as a means of payment. So that's what they're looking for, a means of payment. Low cost, global reach, and speed are all huge potential benefits. Moreover, stablecoins could allow seamless payment of blockchain based assets and can be embedded into digital applications thanks to their open architecture as opposed to the proprietary legal systems of banks. Okay, one more paragraph here. But the strongest attraction comes from the networks that promise to make transacting as easy as using social media, payments are more than the mere act of transferring money. Okay, let's just get to the risk real quick. Policymakers must create an environment that maximizes benefits and minimizes risk. Policymakers will need to innovate and collaborate across countries, but also across functions. So here are some observations for them to consider. Banks may lose their place as intermediaries if they lose deposits to stablecoin providers. And I tell you what, let me put the link here. I don't want to go too deep into this article, so let me go ahead and throw the link here for you guys, and you can go ahead and take a look at it at your own leisure. So I'll put that there. Okay, there you go. So comments. Pudenda Johnson. Hey, how you doing? First time I've seen you here. Also, welcome aboard. Let's see. Josie, electric vehicle coming to fruition in USA. How do people like them? From my understanding, I'm not in the U.S. Right now, but from my understanding, U.S. is a bit slower to adoption for electric vehicles. I think California is actually at the forefront. But the thing is, it's actually the rest of the world that are really into electric vehicles and pushing electric vehicles to the forefront. So, U.S. Of course, it's a huge market, but it's not the only market for EVs. Okay, let's see what else. When fiat backing currency collapses, they won't be stable. Comment from GMAT. You know what? That's absolutely true. I think these stable coins that are, and I'm not going to mention names, but you folks probably know them. Uh, there are some stable coins that have USD backing, and that's the thing. When fiat backing currency collapses, it won't be stable. So if you're into crypto and then you're moving around with crypto, trading crypto, and trying to find that safe harbor for your crypto to find an asset that your crypto can go into, or an asset backed crypto, these cryptos that are in fiat, they probably will have a hard time when things start to go bad, because if you're in crypto, you need to come back out of crypto, right? So you need to go back into some type of asset. And I personally think the asset um, that you may want to be looking at is gold. So I would be looking at crypto that's backed by actual physical gold, and probably a few more things than just being backed by gold. Okay, let's see. Trey Salor, first time I've seen you here as well. Welcome aboard. Blockchain won't matter if a solar flare hits the earth and deactivates all electronic devices or an EMP from a weapon. Can't deny that. That is something you can't deny it, unless you folks know of other technology out there that maybe most of us don't know about, including myself. EMP is always a concern as well. And let's see, cyber price discovery was completely destroyed. Governments will print as much as it takes to keep the bubbles from popping, and the one asset not in a bubble that will benefit is gold, silver too. Yeah, cyber. That's exactly what we mean. There's things that you can do to position yourself where you can slide back and forth between the fiat system and the uh, let's say, getting out of the fiat system and into things that store your wealth. They have their store of value like gold and silver. So there are ways to slide back and forth between the two, and I think that's really really key. Okay, so Jerome Powell came on last week, and he lowered the interest rates. We're now seeing it at 1.75. So essentially, the Fed funds rate, they at the floor they're looking at 1.75%, and at the top they're looking at still 2%. So that's the range that they want to see things work within, 1.75 to 2.0, especially for this is the Fed funds rate where banks go ahead and lend to each other. That's the prescribed interest rate. Excuse me. So I'll go ahead and play that clip from Jerome Powell real quick. This one he's actually talking more about the what happened the night before, when we saw that the repo market coming alive. So this is more about that clip.
We don't see this as having any implications for the broader economy or for the economic outlook, nor for our ability to control rates. The strains in the money markets reflect forces that we saw coming, and they just had a bigger effect than I think most folks anticipated. Strong demand for cash to purchase treasuries and pay corporate taxes. We took appropriate actions to address those pressures, to keep the Fed funds rate within the target range, and those measures were successful. If we experience another episode of pressures in money markets, we have the tools to address those pressures. We will not hesitate to use them. And since we're talking about this, let me take a step back and say this. Earlier in the year, as you will all recall, after careful study over a period of years, actually, the committee announced the decision to implement monetary policy in an ample reserves regime. And we've been operating in that regime for a full decade. We think it works well to implement our rate decisions. The main hallmark of that regime is that we use adjustments in our administered rates, the IOER and RRP rates, to keep the Fed fund rates in the target range. It's designed specifically so that we do not expect to be conducting frequent open market operations for that purpose. So going forward, we're going to be very closely monitoring market developments and assessing their implications for the appropriate level of reserves. And we're going to be assessing, the question of when it will be appropriate to resume the organic growth of our balance sheet. And I'm sure we'll be revisiting that question during this intermeeting period and certainly at our next meeting.
Okay, so Jay had a bunch of things to say in that short clip. Excuse me again. So I want to take a quick look at comments before I get into what the things that Jay Powell had said. Jess Padayal, so we only buy for silver and gold if pullback occurs, get out, then get in again and aim high. I think most of the guys here, including myself, are going to say you basically buy it and you hope. It's something that you buy and you just accumulate. And I think really that's the name of the game right now. You buy, you accumulate. Don't necessarily want to sell unless you perhaps really have to. But a lot of us do see what's coming ahead, and we're looking at silver and gold not just on the the investment factor, but we're looking more so probably at the insurance factor. So anyway, Jay Powell had a few things to say, and so I think maybe we'll just play this little game here called He Said, We Said. So one of the things that Jerome Powell said in his statement was repos do not affect the Fed's ability to control rates. That's what he said. If we break it down, it probably could be translated into, but we are seeing the market saying one thing while you are saying something else. The Fed will eventually have to give in to market pressure. And that's my take on what Jerome Powell is saying. He also went on to say, strains in the money markets reflect forces we saw coming. They just had a bigger effect than most folks anticipated. Translation: we might have screwed up. We unwound the balance sheet too much, too fast, too soon, and we inadvertently created a liquidity crisis. Maybe we might not have had as good a handle on things as we thought we had. Continuing on, he also said strong demand for cash to purchase treasuries and pay corporate taxes. Strong demand means we need more cash. Strong demand for cash means not enough cash. We need more cash. Liquidity drying up. Banks need cash. That's what we saw, right? Also in his statement, will not hesitate to use tools if pressure resumes. Simply put, everybody stay calm. Stay calm. We got this. It's all under control. Stay calm. Other things Jerome Powell said, sorry about this. He took actions to keep the Fed funds rate within the target range. And basically, demand was too high. Not enough cash. Higher demand means higher prices, which is what we saw. Interest rates rose as high as 10% from what I'm hearing. And the Fed had to inject liquidity to help supply the demand bringing interest rates back down into the prescribed Fed funds target rate of 2% to 2.25%. So we saw demands too high, meaning typically hedge funds, institutions, investors, they will lend to these banks. But what happened was maybe they were drying up as well, or whatever the reason was, the demand for cash was so high that these interest rates started getting pushed up. And the Fed had to come in, jump in, supply that liquidity, and bring those interest rates back down. And yeah, I think I had that mixed up. Will not hesitate to use tools if pressure resumes. I think I said this one earlier. Basically means, but don't worry, we got everything under control. Don't worry. Jerome Powell also said earlier in the year, we told you after a study of a period of years, the committee announced the decision to implement monetary policy in an ample reserves regime. I thought the word regime sounded pretty odd to use that word, but he did. My translation with that is we are going to have to revisit our actions post 208 crisis, but let's first start it with the name other than QE. So it's kind of like a QE light, a soft QE. He also said, we've been operating in that regime for a full decade. We think it works well to implement our rate decisions. And my translation to what he said, we are looking at 0% interest rates once again. They're working their way back down to zero. Are they going to go negative? Don't know. We're going to have to wait and see on that one. And he says they will use IOER to keep the Fed fund rates in the target range. We do not expect to be conducting frequent open market operations for that purpose. Um, Basically, if you have too much reserves, we are going to change the interest rate on you and get you to fall in line with our target rate. Use your excess reserves, or what they'll do is the interest on excess reserves, they will push those numbers up and down accordingly to get the banks to not hoard the reserves. Basically, that's what he's saying, or my opinion as to what he's saying. We will be watching markets and assessing the appropriate level of reserves. My take on it, we don't think it's over. We don't think it's over, and if it gets worse, we're going to have to jump back in. So I think that's what OJ is saying when he makes that statement. And last one, we will be watching when it is appropriate to resume the organic growth of our balance sheet. I found that word strange as well. I think all of you did. Organic growth of our balance sheet. My take, and I think all of yours as well, QE is on the way, or going to be here soon at some point. So I think those were some of the things. If we had to translate Jay Powell's statements into simple English, I think those were the things that he was saying. I mean, you're free to have your opinions as well. Share it in your comments. Let's see. Sorry. Muttley Bones, stack and sit watching it shine. Then, um, well, it's more than that. Like I say, if you understand gold and silver, you know it's not just about the price. You know it's just not about the investment. You're buying it because you understand that it is a store of value, and you need to transition what you have in paper into something else, another asset that can store the value of the paper. Because if anything happens to the paper, you're out of paper, and that's I think that's the advantage, a great advantage that being in gold and silver has. It's not the just the investment part. There's a whole lot more to it. Okay, ride the curve, organic. I think Powell. Let's say, okay, he's an investor of sorts. I guess. Luke Groman is all over this. Yeah, Luke Groman. He's pretty darn good at what he does. and you know, do appreciate what Luke Groban, you know, has to say. And so when these things happen, you know, I try to reach out to some people, guests that we had past interviews, and I think consensus is, you know, the Fed, they lost a little bit of control. Um, the market was basically speaking, and the Fed had to try and regain control a bit. But for the most part, people that we interviewed before, the ones that had an opinion on this, they do think that something else is working behind the scenes right now that we just may not know too much about yet, but eventually will come out, and we'll find out about it. And you know, this repo markets, it it shouldn't be an issue except for the fact that it went on, you know, not just 1 day, 2 days, 3 days, but it continued on to 4 days, and even I was surprised. I thought it would have just been, you know, 1 or 2 day thing, but it went on, and so I'll just roll this short clip on what the guys at CNBC thought about it.
Breaking news from the Fed. Steve Leisman joins us now to try to fix it a little bit. What they
Yeah,
break?
I got it under control now.
Okay.
And this is a new feature, right? This repo thing that the Fed's been doing because we've had this dislocation of the overnight funding rate. This looks better, I have to tell you, because the Fed offered $75 billion of cash to do repo overnight.
Oversubscribed?
And it was 75.5. This is the closest they've been to meeting the demand out there in the market. The stop out rate, which is the low rate, was 180, high was 185, low was 180, weighted average 182, which is closer to where the Fed wants it to be. This is, I'm talking about the Treasury issuance, which was 59 billion. They offered some agency, some mortgage back. So, you know, it may be that we've gotten sort of further from the events that were out there. The tax payments, the Treasury issuance, even the Saudi Aramco thing has been mentioned among some traders as that they all of a sudden needed some cash, and so they withdrew from the repo market. These things take time and they can come back on their own, and there's three solutions out here. One is that the Fed keeps doing these temporary operations. Two is it creates a permanent standing facility to do these sort of things. And then three, which Powell told me in answer to my question on Wednesday, we allow the balance sheet to begin growing again. Estimates I've seen was that it would create natural growth to the balance sheet, $8 to $20 billion a month of additional growth out there. And some people are trying to call this QE light.
It is.
Trying to dissuade them from saying it's QE light because it's natural growth to go along with the growth of the economy. The balance sheet in the old days, when it was $800 billion, not $3.8 trillion, used to grow anyway. Right? It used to grow along with the growth of currency.
Yeah, but is this the new normal? I mean, this is Mohammed Al-Arians. We're never getting a balance sheet that is anywhere near the size that it used to be.
If I could parse your comment there, the new normal is the Fed is operating with a much, much bigger balance sheet that's bigger than the Fed estimated it was going to be when it already knew it was going to be bigger. The old new normal is that it's going to let the balance sheet grow again.
Yeah, so I think that's something we should be a bit concerned about. Just exactly what's going on. You know, being that we have to put so much trust in the Fed and how they're working things. But another part with what happened was the Fed was actually starting to become divided on their opinions. And if you bear with me, I want to roll one more clip on the Fed becoming a bit divided. So just bear with me, one more clip on this.
Steve.
Lower by 1/4 point. The Federal Reserve lowering the Fed funds rate to a new range of 1 3/4 to 2%, down 25 basis points. The Fed said uncertainties about the outlook remain. The Fed will act as appropriate to sustain the expansion. The vote 7-3 with 3 dissents, but for different reasons. The same two hawks who dissented last time, they didn't want to cut at all, Rosengren and George, Boston and Kansas City. But one dove, Jim Bullard, wanted to cut by 50 basis points. So 3 dissents. The last time we had 3 dissents was back in 2016 when there was a vote over no change, and 3 hawks didn't want to do that. They wanted to hike. They're going on now. The projections show a very divided Federal Reserve. 7 FOMC members, a plurality in this case, forecast a third cut this year. That is one more from where we are now. That would bring the rate down to 1.63%, or the average rate. But 5 members see no need for any cuts at all. They didn't even want the one today. So if everybody had a vote, and of course not all the FOMC members vote, there would have been 5 dissents from today. Well, if they voted that way. And 5 more forecast just the one cut this year. Put it all together, do all the math, the median is that this is it in terms of cuts. That's the median of the funds rate forecast for the Federal Reserve. That said, the plurality does see one more cut coming, which is 7. Does it include the chairman? We don't know. That's going to be important.
Okay, so that I think that's pretty significant, maybe even more significant than the Fed cutting rate itself. So if what he's saying, we can expect one more where the Fed basically agrees to bring the interest rate down to 1.5%. But after that, there looks to be huge uncertainty within the Fed. It does look like they're going to be divided after this 1.5 lowering. And so that really does bring up a question. I mean, knowing this, are we going to put our trust and confidence in the Fed or government or an institution or even the currency that they're trying to control, the whole banking system that they're trying to control? And I think this is probably a bigger story than the Fed cutting rates. Is that the Fed looks like they're going to be divided, and that's a bit worrying for me anyway. But it's just something that I wanted to throw out because we do seem to be looking at the interest rate, what the Fed is doing and whatnot, but internally behind the scenes, the way they're voting, it does look like they are starting to split. I don't know if getting fragmented might be too much of a word to use, but it does look like they're getting a bit divided on how they're going to move forward. Anyway, let's take a look at some of your comments. JPM is part of the Fed. Never know, but we do know for sure that the Fed is not part of us. It's not part of the U.S. government. It's not part of any government. It's not part of any nation. They are their own thing, as I believe most, if not all, central banks are. They are separate from the governments that they control the money supply for. Huster of Carcosa, haven't seen you here. Welcome aboard. It's always such a tough compromise between maintenance of dollar value and market desires. You know what? That is true. And, I think it's a tough compromise if you are trying to eliminate that free market invisible hand. I mean, if you just let the market go, the market's going to tell you what it needs. Market needs liquidity. Sometimes the market just needs to simply restart, reset, restart, whatever it is. The market will tell you what it needs. And again, that's the reason why a lot of us, we are buying silver and gold, precious metals. We are buying assets where we can essentially get out of that fiat currency system or the current system, monetary system that we're in right now, because we do see that, things are, if not unraveling, starting to get frayed a bit on the edges. And, it's better to be a bit early on things and see things for how they can potentially be. And again, the good thing with silver and gold, extremely liquid, where, if you feel like, okay, the system is safe, I'm not too worried about it. Very liquid, sell it back and go back into fiat if that's what you want to do, or crypto or whatever else. But that's one of the, again, one of the better things that silver and gold does is it is extremely, extremely liquid. Okay, yellow blood silver fox. Again, new guy. Welcome aboard. Think the writing is on the wall. Rates will never become normal again. Yeah, I think just as they said, that balance sheet, I don't think it can come back down. I think Jay Paul tried to unwind it a bit and didn't work. Like I said, maybe he went too fast. Maybe it was just too soon. But for whatever reason, the banks needed cash again. A lot of people are saying it's simply because they need to keep a certain amount of reserves on hand due to regulations, and that's all it is. They just needed more cash to meet those requirements. But a lot of the news had to do with repos this past week, and the one thing about repos, I know it's something maybe not everyone understands, but the first thing you need to understand about repo is it means repurchase. It doesn't mean repossess. A lot of us, when we think of the word repo, we think of what happens when you miss your car payments, and then that tow truck comes late at night and takes your car away, and it gets repossessed. The bank repossesses your car. That's not what it is. The repo or repo market basically means repurchase, and that's what the intention is. Where banks, they're going to sell off securities with the intention to buy them back, possibly the next day, and get some cash for it to meet their minimum reserve requirement. So for the most part, that's what a lot of us were thinking that it is. Without trying to get too deep, or without thinking in too many different ways what is going on, because right now I think a lot of us we don't exactly know what's going on with it. But okay, repos. Let's get into that for a bit. So, oh, hang on for a bit. Wrong one. Okay, so repos, according to Investopedia, a repo is a repurchase agreement. Okay, a repurchase agreement or repo is from it. Well, sorry, is a form of short-term borrowing for dealers in government securities. In the case of a repo, a dealer sells a government security to investors, usually on an overnight basis, and buys them back the following day. For the parties selling the security and agreeing to repurchase it in the future, it is a repo. For the party on the other end of the transaction buying the security and agreeing to sell it in the future, it is a reverse repurchase agreement. Repos are typically used to raise short-term capital. Okay, so I'll play a quick video that Investopedia provided on explaining a repo a bit more.
A repurchase agreement is the equivalent of a short-term collateralized loan. An owner of marketable securities sells those securities to a buyer for cash. As part of the deal, the seller agrees to buy back the securities at a later date. That later date can be the next day, or maybe the next week. The price paid to repurchase the securities is higher than the original selling price. The spread between the original price and the repurchase price is equivalent to interest. Repurchase agreements are often used by institutions with available cash that are looking for quick, easy ways to get a return on their money with little risk. Shelley has $1 million in treasury bonds. Lindy has $1 million in excess cash and wants to earn some revenue without tying it up in a long-term investment. Shelley is the seller and borrower in the repurchase agreement. Lindy is the buyer and lender. Shelley agrees to sell the treasury bonds for $1 million, but on the condition that she buys them back from Lindy next week for $1 million plus an additional $956. The $956 is considered the equivalent of interest. One risk to keep in mind, the original seller might be unable to repurchase the securities. In that case, the buyer has the right to sell the securities on the market. To mitigate this risk, repurchase agreements are usually collateralized with securities with a market value in excess of the amount paid for them.
Okay, so in a nutshell, that's what a repo is. To break it down even further, I think the easiest way to think of a repo, and bear with me here, the easiest way to think of a repo is to think of a pawn shop. Okay, let's say you need some cash. Okay, you need some cash, and you have a watch that has a good brand name watch that has value on it. You take it to the pawn shop. The pawn shop is going to assess the value of that watch because that watch is going to be the security or the collateral for the cash that they're going to give you. And that cash that they're going to give you, you agree on a certain time frame at a certain interest rate with the understanding that you're going to come in to repurchase your watch. Now, that in the simple way to look at the repo, the overnight market, that's what it is. Banks needed cash. They went in to the overnight market. They offered securities as the collateral for that cash with the intention that they will come back tomorrow or the next day to repay that loan. So that's all it is. Okay, more or less that's all it is. But of course, it's bigger than that, where you have to wonder why does the bank have to go into the repo market to get cash? Okay. Now, typically, I think we can assume that banks would just normally call each other. Hey, Citi, Can I borrow some money just overnight, just to fill up the vaults, meet the reserve requirement? Hey, JP Morgan, can I borrow a bit? Hey, HSBC, can I borrow a bit? Hey, Bank of America, can I borrow a bit just overnight, just to meet my minimum reserve requirement, and that's it. You'll get it back the next day. I mean, you got to think these guys called each other and hey, and try to shuffle money around, move money around, and everybody closes the vault at night, and we're all good. We all have enough cash. In a simple way, now I'm looking at this. So you have to think this is what they did, but when they called each other and what they got was, sorry, I can't. No, I can't do it this week. I can't help you out today. I'm sorry, I need mine. Whatever the reason, they couldn't do it. And they go into this repo market, and usually, like I say, typically you do have like hedge funds in there, investors in there, guys who can provide some a great deal of liquidity. You have guys in there, and the Fed funds rate, the prescribed interest rate, should have been between 2% to 2.5%. So anytime they lend that money, it should stay hopefully within that range. But what we saw was the demand was so high, it moved out of that range. It moved up 4%, 10%, went way too high. Fed had to come in, inject some cash into that repo market where banks could, it basically brought the interest rate back down. That's what the Fed's goal was, to bring that rate back down. And what they did was they offered, I think, 50 billion the first day, 75 then, or whatever it was, 75, whatever it was. They threw in so much money to bring that interest rate back within that range where banks could go ahead and get liquid again, get the cash that they needed. And again, they used security, so that was their collateral. And but the thing is, we're still trying to understand, why did banks need it? And we were told, it's fiscal year coming up, or end of fiscal year, they need to, kind of settle their books in some ways, corporate taxes, operations, whatever it was. We've heard all of these stories why the banks needed money, but I'm, I'm not really buying any of those, and I'm sure you folks probably aren't buying any of those reasons as well. Banks needed cash. The banks needed cash. And personally, I'm looking at it this way. If banks buy gold, I'm buying gold. If banks need cash, I'm taking my cash out as well. I want my cash with me. If they need that cash, they're not going to get my cash. I need my cash. And this is one of the reasons why we do have guys always saying, there are a lot more digital dollars floating around than physical dollars. So it may be a good idea to make sure you always have physical dollars on hand, because something should really happen. You want to have those physical dollars. You don't want to go to an ATM and you know your allowance is $50 a day or whatever may happen, like how it happened in Cyprus, I believe. So my take on this is, if the banks buy gold, I'm buying gold. If the banks need cash, I need cash. I'm not going to let them take my cash. So for whatever reasons, banks are having a bit of a rough time being liquid right now. So I'll take a look at some of your comments as well. Let's see. Banks with yellow blood, silver fox. Banks with no cash is like KFC with no chicken. That's a good one. Hey, but that day might come. The way people they want their plant-based meats, we may see plant-based chicken. Who knows? So maybe you're a prophet there, right? Uh, Pablo Pina, I don't have the privilege to call my friend and ask to borrow 50 million and I pay you back in a few nights. This raises a red flag for me. Exactly, Pablo. We don't have friends like that. Banks do. And when they can't cover for each other, and have to go into that repo market, it does say something. And eventually we're going to get to the bottom of it, but I hope we can get to the bottom of it and understand what happened without some type of a crisis happening. But it doesn't look good. That is true, but we'll see what happens. And why I say it doesn't look good is because typically, like I say, these things are, it's overnight, 1 maybe 2 days, whatever it is, and then you're okay. You should be okay. So if you're giving these reasons for corporate taxes and whatnot, all these reasons, then you got to ask yourself, then why do we see the New York Fed going to pump in 75 billion into money markets daily through October 10? Again, that's a huge red flag. If there's anything bigger than a red flag, let's figure out what it is. But I think this is a big deal. New York Fed to pump 75 billion into money markets daily through October 10. So that tells you banks are having a rough time with liquidity, and if banks need cash, so do I. I need cash. I'm not gonna let them have my cash. I'm not saying let's start a bank run. I'm just saying, be aware of what's going on. So taking a look at this article, New York Federal Reserve Bank said Friday it will inject billions into the U.S. financial plumbing on a daily basis for the next 3 weeks in an effort to prevent a spike in short-term interest rates. The Fed will offer up to 75 billion a day in repurchase agreements, exchanging secure assets for cash for very short periods through October 10th. In addition, it will offer 3 14-day repo operations of at least 30 billion each. All right, so we're seeing all these rules changing, and it's a new game. Banks have struggled in recent days to find the cash needed to meet reserve requirements, okay, which is fair enough. Maybe that one we can kind of see, but it doesn't say why they can't meet their reserve requirements, or maybe it does. They're struggling to meet reserve requirements, which has pushed up short-term borrowing rates, prompting the New York Fed to pump billions into U.S. money markets with repo operations over the past 4 days. So this is what we were saying, where once it came out of that 2 to 2.25% range, and it went above, the Fed had to jump in, inject money to bring that rate back down. Basically, the demand for cash was so high, it pushed up the rate, and the Fed had to meet that demand by supplying the cash to bring down that rate. Supply and demand, right? Okay. However, in a sign, a cash crunch could be easing. Hope you're right. Demand for liquidity on Friday did not significantly exceed the amount offered as it had on 2 prior days, which is what that clip just showed. The first day or the second, third day, the demand for cash was more than the Fed had injected. And on Friday, what we saw was the amount that the Fed was putting in was right about at the amount that the banks needed. So this is what that is referring to. After October 10th, the New York Fed will conduct operations as necessary to help maintain the federal funds rate in the target range, the amounts and timing of which have not yet been determined. Okay, so they're already preparing. They, for some reason, they understand that it may have to go on a bit longer than we thought. This is why some people are calling it QE light. It's like a soft QE, or it's QE without mentioning the word QE. So this is going on in the repo market right now. Economists say an array of conditions converge to dry up liquidity in the banking system, including quarterly corporate tax payments, which we touched on, and a surge in government debt sold to investors, which drained cash out of banks. Maybe, could be, but why so long? Why are we gonna need this all the way until October? That doesn't really answer that question yet. Banks borrow regularly in markets for very short periods. We touched on that, usually overnight, to make sure their daily cash reserves do not fall below the required level, but interest rates increase with demand, which is what we talked about. The demand for that cash was so much that those rates got pushed up. The New York Fed adds or removes liquidity to keep interest rates in line with the desired target, pump in cash. But the cash shortage in recent days prompted it to pump funds into the short term repo market as rates soared and threatened to break out of the Fed's target range. The central bank cut benchmark lending rates interest the central bank cut benchmark lending rates interest rate on Wednesday and also made some technical adjustments to try and keep the market rates from breaking out of range, including cutting the interest it offers, on bank reserves held at the Fed that are in excess of the minimum required level. So there's two things. The banks need to have a minimum reserve. They need to have so much in reserves, cash in reserves minimum. That's one part of it. Now, if you're thinking, okay, I'm just going to have a lot of cash and I don't need to worry. Well, you do, because the Fed is going to do things to get you to put that cash back out and get it in the system to work again. So there is a balance between the two, and I think banks are, maybe they're trying to find that balance there in some ways. That could be it. But again, why so extended into October? I mean, this is 2 3 weeks away, 2 weeks away still. So why are we looking at this when typically it's a very short term, one and done, maybe one and done type of a deal, but it doesn't look like it's going to be that at all. Okay. Kirsten Strand, how you doing? Haven't seen you in a while. So they announced they are moving to a cashless society. Maybe we should connect the dots. Always connect the dots, and I think you are on point. You're on point, Kirsten. Let's see. Johnny Doe, this dwarfs the 2008 bailout by far. You know what, Johnny? You hit something on the head, because going back to that 2007, 2008 crisis, we've been down this road before. And what's not often talked about was the run on the repo markets before 2007, 2008 crash really happened. And I was going to bring this up a bit later, but I'll bring it up now because you nailed it. You absolutely nailed it. The role of repo in the financial crisis. This is coming from Stanford Business Graduate School. Okay, so pretty credible, pretty credible article here. Researchers look at the effect of banks' off-balance sheet collateralization of commercial paper in the recent financial crisis. So although this is dated to 2012, I mean, it's still very, very relevant as far as what happened with that 2007, 2008 crisis. Where it began, let me go down a bit here. Okay, sorry about that. Let me go back up. The timing and magnitude of events leading up to the crisis indicates that more was going wrong than just failures in the mortgage market and a so-called run on repo, which some researchers point to as a prime cause of the collapse. Run on repo. Are we seeing that? Are we seeing a run on repo? Don't know yet. But the difference here is here it's the mortgage market. It was more than just the mortgage market that was going on. There's a run on repo. Back then, I think they were running on corporate paper, which is basically um, unbacked securities. Let's say today they're looking at securities, so they are looking at more secure forms of issuing cash back out into the markets when people come into the repo markets. Back then, a lot of it was corporate paper, so it's a bit of a different situation, but still the repo market had a role to play. So where the crisis began, subprime mortgages started to deteriorate back in 2007. We went over this last week, 8 months before the panic that hit that August, and those losses were not large enough to have caused so much systemic damage. One factor frequently discussed is the rapid expansion and subsequent collapse of the shadow banking sector. Some people do say the repo market is a bit of a shadow banking sector. A collection of investment banks, hedge funds, insurers, and other non-bank financial institutions that replicate some of the activities of regulated banks but are supervised differently. In years leading up to the crisis, these institutions held a wide variety of loans, including residential mortgages, auto loans, and credit card loans, which traditionally were held by the commercial banking sector. Instead of being financed by deposits in commercial banks, these loans were funded by repurchase agreements, popularly called repos, and asset backed commercial paper or ABCP. Okay, so I need to back up and clarify. Some of these commercial papers, they were asset backed. Okay, repos and asset backed commercial paper are both short term lending instruments. In the case of the asset backed commercial paper, a company or group of companies will sell receivables to a bank, which in turn will issue them to its investors as commercial paper. Commercial paper is backed by the expected cash inflows from the receivables. Repos are very short term collateralized loans that work something like this: a dealer sells securities to an investor with a promise to buy them back for the same price plus premium. The size of the premium depends on the perceived risk. So, again, in simple terms, think of a pawn shop. Just think of a pawn shop, how you would operate in a pawn shop. More or less, it's pretty parallel to the way the overnight market works, the repo market works. So starting in 2007, the shadow banking system suffered a severe contraction. Why this happened is poorly understood, but a popular theory is that a lot of the short-term funds received by shadow banks prior to the crisis took the form of repurchase agreements, which is where we are right now, and that many of these repos were backed by securitized mortgages as collateral. Okay, so mortgages were the security back then, and we all know what happened. The mortgage market kind of fell apart, which means the repo market really exploded. So, according to this view, the shadow banking system collapsed when money market funds and other cash lenders became concerned about the quality of the collateral that backed repos and withdrew their funding. So, in this case, what we're seeing is the collateral needs to be something solid, which is why they're looking at securities, right? And looking at what happened back then, with the housing market, it being risky. At that time, they didn't think it was risky. They felt secure with it. Today, they feel secure with the treasuries being the collateral. Back then, they felt secure with the mortgage market, mortgage-backed securities and whatnot being the collateral. So there's a little bit of a difference where the securities are more secure this time around with the repo market, but nonetheless, we are seeing the repo market um, starting to get a bit more popular for banks. Back then, it led to a run on the repo market, which is kind of what we're talking about, akin to the bank runs that played commercial banking prior to the introduction of deposit insurance. But this gentleman says that the focus on the repo market as a major culprit in the financial crisis is an error. So this guy is saying it's not so. So there, I'll end it there. So there are, always going to be two arguments to everything. But some people say no, some people say yes. And the thing is just to point out that the repo markets, they were active. That's undeniable. Whether they were the cause of or not of the 2007-2008 crisis, still debatable. But nonetheless, they were active before the crisis started to happen. So let's take a look at some of the comments here. Uh, Pawn shops are more reputable. Pawn shops are cool. Pawn shops are cool. Cyber, the takeaway lesson is do what central banks do: hoard gold and cash. Yeah, I'd have to agree. Get gold, get silver, um, keep it, keep some on you, and I am an advocate of keeping some away from your reach, because if it's out of your reach, it's out of your government's reach, and as long as it's in a safe jurisdiction, I think the needle of stability points in your favor, and that's it's something I'm an advocate of now. Now that I understand, like I say, being in Singapore since 2005, I understand what it's about. I understand how it works, and I got to admit, if I were back in the States, there is no way I would think about sending something overseas. But now being overseas, and especially in Singapore and seeing how it is here, I'm okay. I would be okay with it. But that's me. I know many of you feel the same way, and many of you don't, and that's fine. I mean, no right, no wrong answer. For me, I feel I need some with me, and I need some out of my reach. Because if it's out of my reach, it's out of my government's reach. With the idea that if there is some type of a fiat event, fiat collapse, it's not too far fetched to think that there may be a government collapse as well. So that's the reason why I want to keep some out of reach. Okay, let's see what else. Hustler of Carcosa, I did the math on it. The average USA hourly salary is around $22 with gold at 1,500. That around 68 hours of work to attain a single ounce, which is underpriced. Yeah, it's all on the price, and I think I demonstrated before where if you right now in the States at least, they really want a $15 an hour minimum wage, and the thing is, a $15 minimum wage in fiat is the equivalent of $1.50 in pre-65 coins. In other words, if you have 6 quarters, just 6 quarters, that's $1.50, right? But pre-65 quarters, those had 90% silver in it. So if you weigh those 6 quarters, you have roughly about an ounce of silver, factoring in the 90% silver. You have roughly about an ounce of silver, which is at $18 today. So it's pretty odd how, had they again left the silver in the coins, $1.50 would be that $15 minimum wage. So it goes to show how silver does fight off inflation. Gold does fight off inflation. It is a store of value despite the daily moves up and down, up and down. Long term, perfect store value. It really does well. And when you explain that to people where all you need is $1.50 in pre-64 coins or pre-65 coins, and you have your $15 an hour salary. So, it again, it just goes to show how fiat depreciates and gold and silver will store the value. So as your fiat's going down, you need to cut it off somewhere, put your fiat, your paper into gold and silver, and let it sit. Just it will ride out inflation. It'll store the value of your fiat. And again, even if it's with us, you can always collateralize it and redeploy assets. So for me, gold and silver it's a really good thing. It's a really good insurance investment. Okay, let's see what else is out there. Okay, mentioned, so I'll take another look at the spot price, please. Okay, we'll take a look. Okay, we're at whoa. Okay, so we started out at $18.02. We're now at $18.32. So there you go. Hey, always feels good when you're talking about gold and silver and they do well for you, right? I'd imagine the ratio's back in 83 range. Yeah. Okay, so it's at 83. So okay, something's going on. Something's definitely moving silver. Maybe Asia's also getting spooked with the things that we're talking about. Don't know. Maybe something else is in the news right now, but silver's on a move right now, and it's again, it's a good thing to see. So the thing is, like I said, we've been down this road before with repos. Keep an eye on it. You have to keep an eye on it and just stay alert to it. Last week, we talked about Lehman Brothers and the collapse. And, the thing that happened right after the Lehman Brothers collapse was AIG. So let me get back here real quick. So this is March, September. Okay. So last week we talked about Lehman Brothers. They filed bankruptcy. Right after, AIG gets bailed out. And AIG is another big thing that we need to talk about, because there are some things, not necessarily with AIG, but the pattern is starting to repeat. So just like we're seeing the pattern with the repos, we're starting to see some patterns with what happened back then. So I'll run through this really quick. AIG was one of the beneficiaries of that 2008 bailout of institutions that were deemed too big to fail. Insurance giant was among many that gambled on collateralized debt obligations and lost. CDOs, collateralized debt obligations, otherwise known as CDOs. To explain CDOs, I'll run a clip from one of our favorite movies, Big Short, and it'll explain a little bit about CDOs.
Subprime loans. How much money could be out there betting on it in your synthetic CDOs, swaps, right now, tonight?
50 million. $1 billion.
What?
If the mortgage bonds that Michael Burry discovered were the match.
How much bigger is the market for insuring mortgage bonds than actual mortgages?
About 20 times.
If the mortgage bonds were the match, and the CDOs were the kerosene-soaked rags, then the synthetic CDO was the atomic bomb with the drunk president holding his finger over the button. It was at that moment, in that dumb restaurant, with that stupid look on his face, that Mark Baum realized the whole world economy might collapse. And I know what you're thinking. What the fuck is a synthetic CDO? Well, here's Dr. Richard Thaler, father of behavioral economics, and Selena Gomez to explain.
Okay, so here's how a synthetic CDO works. Let's say I bet 10 million on a blackjack hand.
10 million because this hand is meant to represent a single mortgage bond. Okay, Selena has a pretty good hand here, showing 18, dealer showing 7. That's a really good hand for Selena. Good odds. In fact, her chances of winning this hand are 87%.
So, my odds are good. I'm on a winning streak. Everybody in this place wants to get in on the action. How could I lose, right?
Now, this is a classic error. In basketball, it's called the hot hand fallacy. A player makes a bunch of shots in a row. People are sure they're going to make the next one. People think whatever's happening now is going to continue to happen into the future. During the real estate boom, markets were going up and up, and people thought they would never go down.
So people who are watching and think that I won't lose will make a side bet. Now this is the first synthetic CDO.
I love Selena Gomez. I bet you 50 million she wins, and I'll give you 3-to-1 odds.
3-to-1 odds? Okay, I'll take that bet.
Now, somebody else is going to want to make a bet on the outcome of their
Bet you
bet.
50 million she wins.
That will lead to synthetic CDO number 2.
Hey, I bet you 200 million that lady in the glasses wins that bet.
She probably will win, so I want a great payoff.
How about 20-1?
Deal.
And this will go on and on with more and more synthetic CDOs.
And we can transform an original $10 million investment into billions of dollars.
You okay?
No. I actually feel pretty sick. So I'm going to leave.
Yeah, that was a tough break. CDOs, collateralized debt obligations. Let's take a quick look at Investopedia. What is a collateralized debt obligation, or CDO? As we saw in the movie, it's a structured financial product that pulls together cash flow generating assets and repackages this asset pool into the discrete tranches that can be sold to investors, which it was. A collateralized debt obligation is named for the pooled assets such as mortgages, bonds, and loans. They are essentially debt obligations that serve as collateral for the CDO. The tranches in a CDO vary substantially in their risk profiles. The senior tranches are generally safer because they have first priority or payback from the collateral, even in the event of a default. As a result, the senior tranches of a CDO generally have a higher credit rating and offer lower coupon rates than the junior tranches, which offer higher coupon rates to compensate for their default risk. Okay, so getting to the financial crisis, sorry about that. CDOs subsequently exploded with popularity, with CDO sales rising almost tenfold from 30 billion in 2003 to 225 billion in 2006. But their subsequent implosion, triggered by the U.S. housing correction, saw CDOs become one of the worst performing instruments in the bond or in the broad market meltdown of 2007 to 2009. The bursting of the CDO bubble inflicted losses running into the hundreds of billions on some of the biggest financial institutions, resulting in them either going bankrupt or being bailed out through government intervention and contributing to the escalation of the global financial crisis. Okay, so the CDO, basically, we know what that was. You know, all of these things, good and bad, wrapped up into packages, collateralized debt obligations. Guys bought, and they felt that this was pretty safe because in that were mortgage-backed securities. Some people call them MBS for short. Mortgage-backed securities were in those. They felt confident with the CDOs. Everybody felt they were going to make money. AIG wanted in on this. They felt, look, let's insure this CDO with credit default swaps, CDS. So what happened was they wanted in, and basically it's like they will insure all of these CDOs, and companies just only had to pay the premium, which was not, let's say AIG felt that they would just collect premiums and never have to pay out the insurance part of it. And so they went in on it. They went in heavy on it. They felt it was a sure thing. And then we all kind of know what happened after that.
A day after the failure of Lehman Brothers and the fire sale of Merrill Lynch, attention turned to AIG.
The world's largest insurance company, American International Group, is seeking emergency funding as it struggles to stay afloat.
AIG effectively was insuring all the other Wall Street banks.
Wait a minute. All your insurance is from an insurance company that's about to go bankrupt. Now you see how the fire spreads from one company to the next company. And then everybody looks and says, ooh.
AIG must raise at least $40 billion and fast.
AIG, the situation kept worsening. When we got told that they weren't going to make it through the day, you know, the needed balloon, so it was $85 billion. Imagine that.
Fed can lend against collateral. And we essentially decided that even though the loan to AIG would be very large, that there was enough value in all these insurance companies that we could take it as collateral.
AIG may not have been too big to fail, but it was certainly too interconnected to the economy to fail.
By Tuesday night, the AIG saga is at least temporarily over. They stuffed the turkey with $85 billion and they fired the CEO.
Okay, so why is this why are we even talking about this past thing that happened? Well, investors are flocking back to credit product blamed in the financial crisis. Greater safety seen in synthetic CDOs backed by corporate debt rather than some prime mortgages. Investors are flocking back to a complex debt derivative product blamed for amplifying losses in the financial crisis, reckoning that the securities are safer now. They're telling you it's safer now. Everything's different this time, right? And that they are no longer backed by subprime mortgages. The vehicles known as synthetic CDOs, short for collateralized debt obligations, bundle together derivatives whose returns depend on the performance of bonds, loans, and other debts, providing hedge funds and other investors another way to bet on the credit worthiness of corporate America. Oh, okay, so I think let's just get the gist of it, where investors are going back into CDOs again. And if the CDOs look right, I think safe to say you're going to see these insurance companies jumping in again. And we're going to be right back where we were, 2007, 2008. Although they say this time around the securities are different, you know, I think we've all heard it too many times where this time it's different, this time it's different, this time it's different. So again, you know, this is another thing to keep an eye on because we've been down this road before. We've been down the road before with repos where that market got active before the crisis. We've been down this road before where investors go into CDOs and then people try to insure these CDOs. But they're all saying this time around things are safer, right? So nothing to see here. Just move on, look away, don't worry about it. They're all saying everything's going to be okay. I just want to point out a couple more things. Back in the 2008 crisis, we were only told 2, maybe 3 days before the crisis what exactly happened. We were left in the dark before that. And you know, not to be an alarmist or anything, but we're kind of in the dark right now with these repos. We need to really understand it and know what's going on. But back then, we were pretty close to, you know, to things really falling apart. And I'll give you, I'll roll this short clip for you.
GM, Ford, Chrysler, Harley Davidson, anybody whose existence depended on the ability of your customers to borrow or your ability to borrow. At that point, I think people thought that, you know, it was dire. We were a few days away from the ATMs not working.
I could see the crisis spreading very, very quickly from Wall Street to Main Street.
That week, one of the largest McDonald's franchisees in the country calls Ken Wilson, who's working for Hank Paulson in the Treasury, and literally says to him, I don't think I'm going to be able to make payroll next week. Think about that. And you might say, so why couldn't McDonald's do this? Well, guess what? They rely on Bank of America to roll their paper, and they're worried the Bank of America is not going to do it.
So they were relying on Bank of America to roll their paper, and a lot of banks right now they're having a bit of a issue with liquidity with cash. Not to say any of these things are connected, but just to say we've seen these things happen once, and this time let's be a bit more prepared if these things happen again. So, as Tim Geithner said, we were a couple days from ATMs not working again, which is a good reason to make sure you have cash on you. Because if the banks want cash, so do I. Couple days away from ATMs not working and McDonald's not being able to make payroll. So, those are, things that we don't often recall, or we may not have knew of at that time back then, but they are definitely things that we. This is why we need to be aware of things, because when it happens, it's just going to happen. And again, not to be an alarmist, but simply take some precautions. Like I say, get some silver, get some gold, get some land, whatever it may be, have some cash, and you just want to have these things on the side. And if something ever should really happen, you would put yourself in a different position, probably a little bit of a safer position. And these things, they are generational. You pass it down to your children anyway. Maybe pass it down to your grandkids. So even outside of all this fear and uncertainty going on, it's still a good investment to have. It's still a good insurance to have. So even on just looking at it from a more calmer aspect, it's it's still a good thing to do. All things aside, all of the uncertainties, it's still a good thing to do anyway. So taking a look at some of the comments before we wrap it up. Uh, Hoster, pay me in silver and I'll roll them for you. Yeah, pay me in silver. There you go. Let's see. Nuru Abdi, thank you for the stream. Sure, you're welcome. I know it's running late. We've been here for an hour and a half again. One day I'm going to be able to knock this down to half an hour for you guys, so you can get in and out real quick. But sometimes it's just too much to talk about. What's the HBO show called? You know what? Let me see if I can get that link for you. Um, I should have it here somewhere. I'll post it at the end of the live stream. I did save that link because I figured you guys might want to watch it. It's a pretty good thing to watch. So with all these things going on, again, just don't beat yourself over the head with it. Um, just always be aware. Again, the repo markets, banks just needed liquidity, but it is a bit concerning that they need liquidity for so long, where the Fed is saying we'll go all the way into October. So that's something to be concerned about. And the biggest reason right now probably is just because the banks need to meet that minimum reserve requirement. And a repo is just like a pawn shop. You need some cash, you have a something of value. Pawn shop valuates it, holds it as a security or collateral, gives you cash. You come back in at a later time to buy it. That's all it is. It's not to be thought of as repossession, like when you don't pay something, something gets repossessed. It's not to be thought of that way. And again, repo market's a bit active. We saw it before, and companies are going back into, or investors are going back into CDOs, and we saw that before. So again, not to be alarming or anything, just to say that you know nothing new under the sun, right? So let's just all be aware and be alert. Okay, last couple comments. Um, let's see. Check futures markets, metals rallying. Yeah, we took a look at that when we first started the live stream. Silver was at 1802, and then we've seen it bump up to 1832, I think. So we'll take a quick look where it is now before we head out. And now we're at 1831. Yeah, so still about there. Ratio still at about 83. So yeah, metals are rallying. Um, again, just have some cash on you, have some metals on you. Just basically be prepared. Our job as heads of families is to protect and provide. So let's make sure we take care of those two items for our families and possibly even for our friends as well. Okay. So that's about it. I'm gonna be wrapping up this one. I'll see you guys next week, and I'll put that link in for that HBO movie. But you all take care, and again, two things: saddle up. Be prepared for what's coming ahead. So saddle up and be sure to silver up as well. And I'll see you guys next week. You guys take care and take care of each other.